Welcome to this explainer. Today, we're doing a deep dive into the frankly staggering data behind Nomad Foods. Now, you might not recognize that corporate name right off the bat, but you absolutely know their products. If you've ever had a late-night craving for fish fingers, or you always keep a bag of frozen peas on hand, you definitely know brands like Bird's Eye, Findus, and Iglo. Well, today, we are going to play forensic accountant. We're going to unpack their exact numbers to uncover the anatomy of what looks to be a massive corporate crisis. Here is our diagnostic roadmap for the breakdown. First, we'll look at the symptoms in revenue and margins, then the heavy debt they're carrying, some wild, self-inflicted operational wounds, the threat of private labels, reputational and dividend risks, and finally, we'll answer the big question, value trap or survival. Let's jump right in. Section 1, the symptoms, revenue and margins. Okay, let's look at the actual numbers, and honestly, they are pretty alarming. In the first quarter of 2026, we're seeing a 5.3% organic revenue drop. So what does that actually mean? It means this is a drop in their core, day-to-day business, totally excluding outside factors like acquisitions. And if you look at the volume, the actual amount of food they are moving, it's down 4.4%. So they're selling less food, and whatever pricing adjustments they've tried just aren't making up for that lost volume. And the full-year guidance doesn't look much better. They're predicting another 2 to 5% decline in organic revenue, plus a 5 to 10% drop in EBITDA. Now, EBITDA is essentially the actual cash flow generated from their daily operations. Practically speaking, this data tells us we are staring down the barrel of a second consecutive year with a shrinking top line. And the structural erosion underneath those sales figures, it's severe. To use a terrible frozen food pun, their gross margins are literally melting. We're talking about a fall from a historical peak of 30.63% down to just 25.67%. Now, in the consumer goods sector, a nearly 5% drop in gross margin is absolutely massive. If you track this trend long-term, they're seeing an average annual decline of about 1.2%. The data here is explicitly telling us one thing: Nomad Foods is fundamentally losing its pricing power. Even CEO Dominic Brisby has labeled this a rebuilding year, and he went as far as to say the performance is, quote, not acceptable. But, when you look at the raw data and see 5 straight quarters of volume declines, you really have to ask yourself, is rebuilding the right word here, or is this actually a fight for survival? Which brings us to Section 2, drowning in heavy debt. If falling revenue is the surface symptom, this is the underlying disease. The company is currently suffocating under a staggering $2.3 billion in total debt. To put that into perspective, their entire market cap is hovering around $1.7 billion. So carrying $2.3 billion in debt is just a massive anchor pulling the whole operation underwater. Let's break down exactly what this data means for their day-to-day survival by looking at 2 specific metrics. First, their debt-to-EBITDA ratio is sitting at 6.5 times. That is 26% higher than their own 10-year median, and worse than 84% of their peers in the consumer goods space. Second, their interest coverage ratio is just 2.3 times. That's 45% below the industry median. In simple, everyday terms, this means they are dangerously close to not generating enough cash just to pay the interest on their loans. It's exactly like maxing out a credit card and barely being able to scrape together the minimum monthly payment. Any further drop in operating profit could trigger a severe liquidity crisis. Unsurprisingly, the credit agencies have definitely taken notice. S&P downgraded their outlook to negative, kept them at a BB rating, and explicitly warned that their rating headroom is totally absorbed. So Nomad just tried to buy some time. They did an €800 million refinancing deal to push their major debt maturity out to 2033. But here is the major catch in the data. Those new notes carry a 5.25% coupon. Even the CFO came right out and admitted this refinancing could actually increase their interest expense even further, putting a heavier squeeze on a bottom line that's already shrinking. Let's move to Section 3, self-inflicted operational wounds. What's wild is that a lot of this pain wasn't just handed to them by a bad market. A lot of it is completely self-inflicted. Let's map out this chronological disaster. It all kicked off with a botched SAP Enterprise Resource Planning System migration. If you've ever worked in corporate IT, you know how incredibly risky these big software migrations can be. But this wasn't just a minor tech glitch. It severely disrupted their entire UK supply chain. That disruption directly caused a massive inventory overhang. Because they physically couldn't manage their inventory, they had to cancel marketing promotions. And guess what happens when you cancel promotions and can't reliably deliver products? You lose highly valuable supermarket shelf space to your competitors. That one single operational failure caused 2 separate downgrades to their revenue guidance. To try and patch this up, management is now promising a massive efficiency program, targeting 200 million euros in operational savings between 2026 and 2028. But honestly, you have to look at this target through the lens of recent history. Analysts are highly skeptical right now. After watching a routine software migration spiral into a full-blown supply chain disaster, there are serious, valid doubts about whether this specific management team can actually execute a 200 million euro turnaround. On to Section 4, losing to private labels. This number right here is brutal, negative 190 basis points. That represents the total market share Nomad has lost since 2021. To translate that data into plain English, they have bled 1.9% of total market share, with a 30 basis point loss in 2025 alone. When you are positioned as the premium category leader, bleeding 1.9% of the entire market is a systematic failure to defend your territory. So the crucial point we need to understand from the data is who exactly is stealing all that market share. It's the private label threat. European supermarket retailers are aggressively pushing their own high-quality, store-branded frozen foods, and the data shows these private labels are 30 to 40% cheaper than Nomad's products like Bird's Eye or Findus. This massive price gap completely destroys Nomad's ability to pass their own inflation costs onto consumers. Think about it. When household grocery budgets are tight, consumers will absolutely trade down to a store brand that's 40% cheaper, and Nomad just loses the sale outright. Section 5. Reputation and dividend risks. Beyond the balance sheet, Nomad is facing a really heavy reputational overhang. First, an investigation by the Outlaw Ocean Project raised allegations of forced labor and migrant worker abuse within global seafood supply chains. Now, Nomad strongly denies sourcing from the specific fisheries named, and no direct link has been proven. However, in markets like the EU and UK that have rapidly tightening forced labor legislation, just the association creates massive regulatory risk. Furthermore, there's been some serious market confusion over a securities fraud probe into the OYN brand. If you actually look at the SEC filings, that brand belongs to an entirely different company called Simply Good Foods, but automated third-party aggregators mistakenly linked it to Nomad, which caused even more reputational damage and panic in the market. All of this, the operational strain, the market chaos, the lost shelf space, it's hitting actual cash flow really hard. The data shows free cash flow dropped from 50.6 million euros in Q1 of 2025 down to just 38.3 million euros in Q1 of 2026. This is incredibly important because free cash flow is the actual cash they have left over to pay down their massive debt or to return to their shareholders. Which naturally brings us to their dividend. Nomad currently pays a quarterly dividend of 17 cents per share, which yields a pretty generous 5.7%. For a lot of investors, especially retail investors who are seeking steady income, that high yield is literally the only reason they're still holding the stock. But look at how this data fundamentally conflicts. The mathematics just don't work in the long term. With a dangerously high 6.5 times leverage ratio and completely shrinking free cash flow, every single dollar they spend paying out this 5.7% dividend is a dollar they desperately need to be using to pay down that $2.3 billion pile of debt. Because of this math, analysts are increasingly modeling that this payout is at major risk of being severely cut or completely suspended by 2027. Finally, Section 6, Value Trap or Survival. Let's get to the final verdict. Wall Street has definitely taken notice of all this deteriorating data. They've actively slashed the 2026 revenue consensus down from 3.08 billion euros to 2.91 billion. And they've cut the earnings per share, which is the direct profit allocated to each individual share of stock, from 1.64 down to 1.38 euros. This whole wave of downgrades has left the stock trading at roughly $11.92, which is well below its 52-week high and perfectly reflects the deep skepticism investors have right now. So the market is currently torn between two very different arguments. The bull case rests on the hope that this recent refinancing successfully buys them enough time, that the new 200 million euro efficiency program actually delivers the promised savings, and that their iconic household brands can reclaim their top status after what was a supposedly better-than-expected Q2. But the bear case points to the crushing, undeniable data: a 6.5 times debt ratio, continuously shrinking margins, a devastating 1.9% loss in market share to private labels, and a proven history of severe internal execution failures. With all the financial data laid totally bare, we are left with one absolutely critical question. Is Nomad Foods a value trap that's destined to slowly sink under its $2.3 billion debt? Or is this a gritty survival story of an iconic brand that's ready to make a massive comeback? What you take away from this data will ultimately decide how you view the future of the freezer aisle. Thanks so much for joining me on this explainer, and as always, keep questioning the data.